Have you ever wondered how a conflict far away can affect things all over the world, like the prices in your local market? Right now, there's a big situation brewing between Iran and Israel, and it's making a lot of people nervous, not just in the region but globally too. Now, the latest conflict between Iran and Israel has also sent the Indian markets tumbling down. After hitting record highs, Sensex and Nifty have suffered losses for the last 4 consecutive sessions. In this video, we're going to break down why this Iran and Israel conflict has become such a big deal for everyone, especially for the Indian markets. Also, while the markets are down, it's not all gloom and doom. There are also several positive factors impacting the markets, and we will also cover this. Let's begin. You're watching Informed Investor, and initiated by Research and Ranking. Firstly, let's break down what's going on between Iran and Israel. Now, ever since the Hamas attack on Israel on October 7, 2023, there have been concerns about a wider regional conflict in the Middle East. Now, recently, things got even more intense. Iran directly got involved by launching a big attack. Drones and missiles were sent towards Israel, making everyone worried. And this marked a new, more serious phase of the conflict. Now, the attack was in response to Israel attacking Iran's consulate in Syria, destroying it and causing death of its top commander. Now, the situation shows how the disagreements between Iran and Israel have been getting worse over time in the Middle East. But Israel's ally countries are urging them to calm down and try to make peace instead of going to war. But just as we speak today, Israel retaliated with missiles and drones on Iran. And right now, nobody knows what will happen next. Now, let's talk about the broader impact of the situation on the Indian and the global markets. When tensions flare up in the Middle East, one of the key commodities affected is oil, as the Middle East is a significant producer of crude oil. Now, over the past few days, international oil prices have surged, with the Brent crude surpassing the $90 per barrel mark. Now, this uptick in prices has been fueled by a combination of factors, including the ongoing production cuts by major oil producers and the escalation of tensions between Iran and Israel. Now, why does this matter for India? Well, India ranks as the world's third largest consumer of crude oil and heavily relies on imports to meet over 85% of its needs, and almost half of it comes from the Middle East. Also, most of the oil travels via the Strait of Hormuz, and if Israel goes to war with Iran, this route could be compromised. And at least 4 major oil producers, Saudi Arabia, Iran, the UAE, and Kuwait, will be impacted as most of their oil travels through the strait. Now, given this high level of import dependency and the repercussions of the war, any fluctuations in oil prices can have significant implications for the Indian economy. Now, firstly, high oil prices can lead to inflationary pressures within the economy. Now, when the cost of oil rises, it often translates into higher prices for fuel and other essential goods and services, impacting our purchasing power. Now, inflation globally is yet to come under the targets of central banks, and if geopolitical tensions increases from here on, commodity prices will move up due to supply disruptions. Now, this will throw cold water on the efforts of keeping inflation down, eventually hitting the prospects of rate cuts. Now, moreover, the surge in oil prices can disrupt India's trade balance. Now, with a substantial portion of our expenditure used to buy oil, a spike in prices can widen our trade deficit. Additionally, the value of the Indian rupee can come under strain in response to rising oil prices. Now, since oil imports are typically denominated in foreign currencies like the US dollar, the increased demand for foreign exchange to pay for these imports can depreciate the rupee. Now, as we speak, US dollar is continuously rising, and the US dollar index has come to 106 levels. On the back of this, the Indian rupee has also plunged to fresh lows against the US dollars. With rising geopolitical tensions, investors often become more risk averse. In simple terms, they get a bit nervous about the uncertainties and might want to play it safe with their investments. Now, what does this mean for India? Well, it could lead to more capital outflow from the Indian share market. Essentially, foreign investors might decide to pull out their money out of the Indian stocks and look for safer options elsewhere, such as government bonds. Now, we are also seeing this right now with FIIs turning net sellers this month. Now, another factor driving the markets down is the delay in rate cuts. You see, what the markets have been craving lately are for rate cuts. For almost a year now, there's been a lot of expectations globally for interest rate reductions from the Federal Reserve. Now, until now, there were expectations that the Fed would cut interest rates 3 times this year, with the first cut likely to be in June. But inflation in the US has surpassed expectations. It rose to 3.5% in March from 3.2% in February, above the central bank's target of 2%. Now, US labor market is also looking strong with unemployment at 3.8%. And US retail sales also came in better than expected, which shows consumer spending in the States is still strong. Now, with the US economy showing strength and inflation rates higher than expected, the Fed might have to rethink or delay any plans to cut rates. Now, why is that? Now, strong economic data from the US can reduce the chance of a US Federal Reserve rate cut because it suggests a strong economy. Now, this can lead to concerns about inflation as increased consumer spending may push prices up. Therefore, the Fed might opt to maintain or raise interest rates to prevent inflation rather than cutting rates. So we see there is so much happening and hence the markets have been very volatile. There are also positive factors that are expected to drive the market. Let's discuss those. We know how the stock markets are generally volatile and are largely affected by global happenings, but the same holds true for elections. Now, elections are a major decision point for a country where its future economic, social, and political directions are determined. Now, when a government changes, it can lead to changes in policies, economic priorities, and regulations. Now, these shifts can massively influence various sectors and businesses. Now, elections naturally bring about uncertainty, which is something the markets are not particularly fond of. Now, this uncertainty is why markets tend to be quite volatile around election periods. But here's why it is different this time around. The current polls are hinting at the likely return of the current party in power. Now, this is a big deal because what markets really like is stability. Knowing that the same party might continue means less uncertainty about drastic policy changes. Now, BJP's manifesto may also be a positive factor for the market as it follows policy continuity. But it's just not about winning elections. The real deal is how well the party fulfills its campaign promises. The markets will be watching closely, especially when the new government presents its first budget. Now, that's going to be a major indicator of their actual policy directions. Now, will they follow through on their promises? How will they handle the economy? These are the critical questions that will influence how the market reacts. Now, let's pivot to some brighter economic news from India. The country's retail inflation has eased off to 10-month low, landing at 4.85% in March 2024. Now, this dip comes as a breath of fresh air after enduring months of inflationary pressures. Now, just to put things into perspective, inflation was recorded at 5.1% in January and 5.09% in February. Now, comparatively, in the US, inflation actually hit a 5-month peak of 3.5% in March, staying well above the Federal Reserve comfort target of 2%. Now, digging into what's driving this dip in India, a major factor has been the substantial decrease in the price of fuel and lighting, which actually saw a decline of 3.2%. But there's also what's called a high base effect at play. Now, meanwhile, food inflation remains a concern, clocking in at 8.5% in March. This was primarily fueled by soaring prices in categories like cereals, meat, fish, and pulses. However, this was somewhat offset by price falls in milk products, vegetable, and spices. On other fronts, we are also seeing easing prices in housing, clothing, and footwear. Now, another key measure, the core CPI inflation, which strips out volatile food and energy prices, also came in at 3.3%, which is good news. Now, reflecting on the entire fiscal year, inflation actually averaged 5.4% in fiscal year 24, marking the lowest rate in 4 years. Now, with inflation remaining within the RBI's tolerance limit of 6%, this gives the central bank some relief. Now, with global central banks like the Fed holding interest rates steady, the RBI also opted to keep its rates unchanged at 6.5% during the latest meeting. However, the RBI remains on its toes, cautious of global uncertainties like the recent Iran-Israel conflict, any potential supply chain disruptions, and volatile food prices, all of which could push inflation rates more higher. Now, looking ahead, while the March data provides some optimism, the long-term management of inflation will hinge on how effectively food prices can be controlled and how global economic events will unfold. Now, when we talk about India's economic growth, it is crucial to recognize the important role that rural demand plays. Now, rural areas are home to a significant portion of India's population, and the purchasing power of rural consumers directly influences various sectors of the economy. Now, we've discussed this before, but it's worth emphasizing. The rural economy has faced challenges, especially with the setbacks caused by the pandemic-induced lockdowns and high inflation. However, amidst these challenges, we're beginning to see some signs of recovery. Now, take for instance the FMCG industry, where rural India contributes a substantial 35% of sales. Now, recently there has been an uptick in FMCG sales, which indicates more of a positive trend in rural consumption. Now, according to Nielsen IQ, rural markets showed promising growth rate of 6.5% by volume in both December and January, and an impressive 11.1% in February. In comparison, urban markets saw growth rates of 6.1% in December, 4.7% in January, and 8.7% in February. Now, another promising indicator is the surge in domestic two-wheeler sales over the past few months. The Federation of Automobile Dealers Association, which is also known as FADA, has reported a steady recovery in two-wheeler sales since September last year. Now, as we approach the Lok Sabha election, this trend is expected to gain momentum, with an increase in rural spending likely to spur further demand. Now, we see rural demand has been showing some improvement lately, but we'll need to see this trend continue for a few more quarters to confirm a full recovery. Now, there's also other great news. Last year, India didn't get as much as rain as usual, which had everyone concerned. But the latest forecast from the IMD brings some relief. They're predicting above average rainfall for this year, about 106% of our usual rainfall during the monsoon season. Why? Well, El Nino is weakening and La Nina is on the rise, which typically means a stronger monsoon is on its way. Now, why is this important? When El Nino happens, it usually leads to less rain and lower agricultural output, which can push up food prices and cause inflation across the board. Now, but with expectations of above normal rainfall in 2024, farmers all over the country are feeling optimistic. It bodes well for the agriculture production, which not only helps farmers but also boosts the overall economy. So let's keep our fingers crossed for a bountiful monsoon. Now, the Indian stock market is experiencing a surge fueled by various factors. Now, retail investors are playing a pivotal role in this growth. Now, one of the most compelling indicators of this growth is the surge in demat accounts. As seen on this chart, we've been witnessing a remarkable rise in the number of accounts opened at both NSDL and CDSL, the two major depositories in India. Also, while foreign investors have been selling in the markets, domestic investors have been buying, smoothing the volatility to some extent. Now, adding to the positive outlook, the International Monetary Fund has revised India's growth projections upwards, citing strong domestic demand and a growing working age population. Now, initially, they estimated India's growth for the financial year 24 to be 6.7%. However, based on recent developments, they've now revised it upwards to a robust 7.8%. Now, this upward revision also aligns well with India's own official estimate of 7.6% growth for the same period. Now, just like the IMF, several other rating agencies have also revised India's growth upwards. Now, if you want to know more about how the Indian economy is doing, we've decoded the latest GDP numbers, highlighting the positives and negatives. Do watch it. Indian markets are positioned for growth, and that's no secret. We've got credible experts singing praises about the Indian markets and its bright prospects. Now, this confidence is evident in the significant inflow of capital into the country. Retail participation in the market is also on the rise, indicating growing interest among Indian investors. However, there's a lot happening in the market right now, some good, some bad, with a mix of both global and domestic factors at play. For instance, inflation is manageable in our country, but it's been on the rise in the US, leading to delays in rate cuts in the US, which are crucial for us. Now, India is expected to be as the fastest growing economy globally, but we can't overlook areas of concerns. Growth is primarily being driven by government spending, while private consumption growth remains subdued. While the industrial and services sectors show strength, the agriculture sector is still facing challenges. Additionally, geopolitical tensions and recessionary fears are casting a shadow over the global economy. China's slowing growth presents both challenges and opportunities for India, especially considering the ramifications of a slowdown in the world's largest manufacturing hub. Now, with so much happening in the world, as investors, it is essential to focus on the long-term perspective. Now, ensuring a well-diversified portfolio is crucial, and remember, short-term problems typically have a minor impact in the long run. Also, when we talk about the Indian economy doing well, it doesn't mean every company or sector will thrive. It's important not to underestimate risk and avoid being swayed by misleading opinions. Instead, focus on picking fundamentally sound stocks, diversify your investments, and also master the art of asset allocation to minimize the risk in these tough times. Having said that, this is me, Merlzana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.